So I'm going to go ahead and get started. We're looking at a new American golden age. At least the stock market thinks we have a new American golden age. And we're going to go ahead and invest on that basis. This is John Thomas, the Mad Hedge Fund Trader from Silicon Valley in California, where it's all happening. So take out your pen and paper to take notes or start typing into your smartphone. What I'm about to tell you will blow you away and change your life. For I'm in the early retirement business, your early retirement. If you're wondering what that is, that's a World War II Supermarine Spitfire, which won the Battle of Britain. I fly it about once a year. Why listen to me? Well, I have 55 years of experience in the global financial markets, 10 years as the economist correspondent in Tokyo, Japan, and later the White House, 10 years running the international equity division at Morgan Stanley. Marine Corps combat pilot, Desert Storm, they still call me up every once in a while. 10 years running the first international dedicated hedge fund, 5 years fracking for natural gas in Texas, 16 years now publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who is still breathing. And by the way, if you have any questions on any of this, type it into the chat box. I will be presenting with my left eye and reading the comments with my right eye. Of course, there's another reason to listen to me. I've averaged 51.77% for the last 16 years. And for 12 years, we've been using artificial intelligence, which essentially doubled our performance over time. You can do the same. Of course, our secret is the Mad Hedge Profit Predictor, our market timing index. That's an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. It took a team of mathematicians 1,000 hours of calculations to create this, and it's modified constantly. It works like a charm. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. Does the work of a seasoned 100-man research department in seconds, runs real time and optimizes with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 1,000 times a day. Don't go to a gunfight with a knife. If you're trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your trading profits. And these are the signals we get in a typical 3-year period. You get lots of buys at market bottoms, lots of sells at market tops, buy, sell, buy, sell. It's really a great tool to have at your disposal. I'm not the only one using algorithms. Some 80 to 90% of all current trading is algorithmic driven. And I was walking by the Miami waterfront a few years ago, saw this super yacht called Algorithm. How about that? It's obviously working for him. These are the last year and a half of market timing indicators. This is where we are today, right at 65, which is moderately overbought territory. Anything over 70 becomes extreme overbought territory. And you can see we often spend months in extreme overbought territory like we did from December all the way up until April this year. That was a 5-month run, 5-month top building process. Of course, then we go make a bottom, and strong buys are usually in the 20-30 range. So, ignore this at your own cost. There is a method to my madness. The market has seen the fastest 27% rise in market history. Fed is done raising interest rates. Markets are now discounting the first rate cut in September, and there may be more than one. Jay Powell has written in his own blood a promise to cut rates 3 times by the end of the year, and that kind of looks on track. All interest rate trades are back in play, including bonds, REITs, precious metals, financials, and foreign currencies. The bull market continues, but it's got to catch its breath first before we can make substantial new highs. Otherwise, we just make marginal new highs or new intermediate lows. Oil prices have sold off on a global slowdown. They're weak again today. Tech bull market is back and will continue for years. Time to go aggressively long stocks and bonds. So how to reliably pick an winning options trade? If you have a handle on whether the economy is growing or shrinking, you have a major advantage in the options market. In a growing economy, you only want to employ bullish strategies such as calls, call spreads, and short volatility plays. In a shrinking economy, you want to execute bearish plays such as puts, put spreads, and long volatility plays. Remember, the only thing that is really useful is a view on the economy is what's going to do next. We are all in the what happens next business. Government only publishes historical economic data, which for the most part is useless in predicting what is going to happen in the future. Look for great industry fundamentals. Do you want to give yourself another edge? There are more than 100 different industries listed on US stock markets. However, only about 5 or 10 are really growing decisively at any particular time. The rest are either going nowhere or are shrinking. In fact, you can find a handful of sectors that are booming while others are in outright recession. If you're a major hedge fund, institution, or government, you may want to cover all 100 of those industries. Good luck with that. If you're a small hedge fund or an individual working from home, you'll want to conserve your time and resources and skip most of the US industries and only focus on a handful. And of course, picking the right industries, we have Jensen Huang, of course, holding up his Blackwell chip, which is going to hit the market any day now. Micro picture is ideal. Once you have a handle on the economy and the best industries, it's time to go zero in on the best company to trade in or the micro selection. It's always great to find a good target to trade in because positions in single companies deliver double or triple the returns compared to stock indexes. It's because the market will pay a far higher implied volatility for a single company than a large basket of companies. Remember that you also are taking greater risk in taking on individual companies. One single stock is subject to far greater event risk than a basket. The earnings come through as expected, everything is hunky-dory. If they don't, troubled shares can drop by half in a heartbeat, and then there's guidance to worry about. So a lot of risk in individual stocks. The technicals line up. I've never been a huge fan of technical analysis. Most technical advice boils down to if it's gone up, it'll go up more, or if it's gone down, it'll go down more. Over time, the recommendations are accurate about 50% of the time or equal to a coin toss. However, the shorter the time frame, the more useful technical analysis becomes. If you analyze intraday trading, almost all very short-term movements can be explained in technical terms. This is entirely how day traders make their livings. It's a classic case of enough people believe something, it becomes true, no matter how dubious the underlying facts may be. So it does behoove us to pay some attention to the charts when executing your trades. The calendar is favorable. There is one more means of assuring your trades turn into winners. According to the data in the Stock Traders Almanac, $10,000 invested at the beginning of May and sold at the end of October every year since 1950 would be showing a loss today. Amazingly, $10,000 invested on every November 1st and sold at the end of April would today be worth $702,000, giving you a compound annual return of 7.1%. You can take that over 9% if you add in dividends. Of the 70 years under study, the market was down in 25 May-October periods, but negative in only 13 of the November-April periods, and down only 3 times in the past 20 years. There have been just 4 times when the good 6 months have lost more than 10%, 1969, 73, 2008, and 2020. And as you recall, those were all special event years. Pandemic, financial crisis, oil crisis, Vietnam War, and presidential election for that matter. So let me do the heavy lifting for you. You can spend 12 hours a day, 7 days a week, slaving in front of a computer, making sure all 5 of these criteria line up, or you can let the mad hedge fund trader do the heavy lifting for you for a year and spend just 5 minutes a day reading our trade alerts. Adopt these 5 simple disciplines, and your success rate on trades jumps from a coin toss to 70, 80, or even 90%. In other words, you convert your trading losses from an endless series of frustrations to a reliable source of income. If a potential trade meets only 4 or 5 of these criteria, please do it with your money and not mine. Your chances of making money have just declined. And I bet a lot of you poor souls out there execute trades all the time that meet none of these 5 criteria. So let's talk about individual sectors. Precious metals, we absolutely love. There's a massive short squeeze going on where miners cannot get supplies to the futures market fast enough to make delivery. And that's forcing them to buy back their own shorts, driving prices up at an exponential rate. Demand for silver from the makers of solar PV panels, particularly those in China, is forecast to rise by 170% by 2030 to roughly 273 million ounces, or about 1/5 of total silver demand. That's a lot of silver. Global investment in solar PV manufacturing more than doubled last year to around 80 billion. And although Biden is banning Chinese solar panel imports, that doesn't affect the rest of the world. And it turns out that's where the high growth will be. Do you want to be selling to a country that's already largely built out in solar panels, or one that's starting from scratch? Miners are expanding their operations and ramping up production as prices for precious metals climb to decade highs or all-time highs. Central bank buying of gold is accelerating now, and they are joined by former retail speculators fleeing a collapsing real estate market. Gold should reach $2,000, silver $50 in 2025. So here's the gold chart. We're looking for 3,000. We've been trading it since last October when it was back here at 1,700. If you like gold, you'll like the world's largest gold miner, Barrick Gold, which is just breaking out on the charts. Silver has moved 3 times faster. Just in the last 2 months, it's gone from 22 for the SLV to 32. That is a 50% gain in the ETF in just 2 months. That is a heck of a move, and we're still buying dips. Wheaton Precious Metals mines both gold and silver and is a revenue stream royalty stock. They don't actually own any mines, but it is a leverage play on the gold and silver space. It's just moved from 38 to 57. Again, we're looking for $100 for Wheaton Precious Metals. Platinum has also gone ballistic. Buy that on dips. There's a 556,000 ounce shortage of production this year. Stocks, of course, a very important sector, up 11 out of 13 days on consistently slowing economic data means the soft landing is here and interest rate cuts to follow. Bull market has 5 more years to run, with the S&P 500 going earnings at 10% a year for the foreseeable future. Company share buybacks are surging as companies race to pick up their own stocks before they become even more expensive. Buybacks should top $1.25 trillion this year. Lower interest rates means they buy back even more. Last year, the S&P 500 earnings was $222 a share. This year will be $250, then $270, then $300 by 2026. Profit margins are also expanding at all-time highs. Falling rates and a weak dollar will boost exports to recovering Europe and Japan. Inflation should hit the Fed's 2% target 2025 as AI chatbots replace workers at a breakneck rate. It all really sets up a new American golden age and a Goldilocks scenario for the markets. Buy everything on dips. Future is happening fast. So this what was in the market last year: high inflation, an oil shock, labor shortage, supply chain headaches, Fed interest rate rises, quantitative tightening, and poor earnings. What happens this year? Cheaper gasoline prices, rising commodity prices, a stabilizing supply chain, record low 3.9% unemployment, better than expected earnings, huge stock buybacks, falling interest rates, and a weak dollar. By the way, that's a longhorn steer I found wandering around in Fort Worth, Texas, right next to Billy Bob's. The trader's dilemma. choice now is between 5 stocks that have gone up in a straight line for really 6 months now, or a dozen interest rate sensitive sectors that may be dead money for months, but may have the greater upside gains. Avoid the frustration trade, the trade you should have done on October 6th, 7 months ago. Wait for the ideal AI entry point, no matter how long it takes. Big chunk of 2024 performance was pulled forward into 23, and you've already made that money. The sole exception is energy, which is driven by demand from the Chinese economy, which has been weak. With markets at all-time highs, 90-day T-bills are still paying 5.4% if you want to whip out and stay out of the market. So we run barbell portfolios, 75% big technology, 25% domestic recovery, and of course tech is 2% of the workforce, now 30% of the market cap, and 30% of US earnings. Domestic, oops, there we go, let's go back here. Domestic recovery include railroads, airlines, cruise lines, couriers, steel companies, banks, commodities, construction, credit card companies, hotels, casinos, and online ticket sales. Here's the main index, NASDAQ, now at 16,686, looking for 20,000 by the end of the year, or a gain of about 20% from here. And of course, these blue boxes down here, they showed signals from our market timing index, when to buy, when to sell. Right here, it showed a buy of Microsoft at 310. It's now at 425 on its way to 500. Meta, we bought down here at 290. Now at 470 way on its way to 700. Amazon, we bought down here at 120. Now at 184 on its way to 250. NVIDIA, we bought down here at 400, believe it or not. We bought leaps, call spread calls. We bought everything we could find. Deep out of the money calls, long dated calls. Really got to be a pro in the NVIDIA instruments out there. Went from 400 to 950. We're looking for 400 by the 1400 by the end of the year. And Google knows everything you searched for the last 20 years. You think that's worth a lot of money? The market thinks so. We bought it down here, just above 120. It's hit 176. We're looking for 250. So Salesforce is another one. We got a signal to buy down here at 200. Went to 315. We're looking for 400 by the end of the year. Palo Alto Networks. Hacking never goes out of style, and 3 companies have a near monopoly, so customers have to buy all 3. We've been trading this stock actually for 10 years. Our last buy, 240, got as high as 380, now back down now to 315. We're looking for 400 by the end of the year. Second half of the barbell bets on a global economic recovery to begin this year. Upside potential for stocks and domestic stocks is greater than it is for tech from here. Some of these things have not moved for 5 or 10 years. Focuses on economically sensitive cyclical industries, makes a great counterweight to high growth technology. We could spend the next years rotating between the 2 groups, tech and domestics. JP Morgan, of course, the premier bank in the United States. We got to buy back here in November at 135, hit 204. We're looking for 250. Visa, the touchless payment system, grows in line with internet sales and inflation. It's a great inflation bet. We bought them down at 230, made it up to 290, and we're looking for 400 by the end of the year. Union Pacific, any economic recovery means you have to move a lot of big stuff. We bought it down here at 200, hit 255. We're looking for 350 sometime next year. And Federal Express, you also have to move a lot of small stuff in an economic recovery. Just had a decent sell-off on weak guidance. You can buy it down here, and we're looking for $300 by the end of the year. Berkshire Hathaway is the one-stop barbell stock. They are the largest independent owners of Apple, and also are a major player in insurance and financials. We've been trading this literally forever. Bought it at 330 most recently, hit 416, and we're targeting 500. Bond market, another important asset class. They are stabilizing. Bond investors are making a killing, with the U.S. Treasury paying out $900 billion in interest payments last year. That's double the average annual cost of the past decade. Remember those coupons. It's another reason for the Fed to cut interest rates soon to lessen this backbreaking burden on the U.S. government. After being held hostage by zero-rate policies for almost 2 decades, Treasuries are finally reverting back to their traditional role in the economy. Bonds are becoming respectable again after a long winter. Buy the TLT on dips. And now the Treasury is back buying their own bonds back to smooth out liquidity in the market. This hasn't happened since 2000. So if you're buying bonds, chances are you're in competition with the government, who finally is getting into the buyback business. How about that? So here's the TLT. Was the short of the century, then became the long of the century. We got out here on this recent rally, been chopping down ever since. I think we're in the process of setting up a head and shoulders bottom right here as we start to discount the start of Fed interest rate cuts. So we've been buying down here, and we're looking for 110 by the end of the year, up from the current 91. Here's the 10-year Treasury yield. It peaked at 508. Back here, we're looking for 350 by the end of the year. Foreign currencies, a dollar top is in the process of putting itself in. Falling U.S. interest rates mean that a crashing U.S. dollar is inevitable. All foreign currencies will rally strongly. Buy the euro, the Australian dollar, the British pound, and even the Japanese yen, if someone holds a gun to your head. Soft Chinese economy will keep the yuan relatively weak. 40 years of one-child policy have created a shortage of consumers and home buyers today, causing a financial crisis. Strong currencies will also deliver major bull markets in emerging market stocks like the EEM. Australian dollar is our #1 favor. We got a buy signal back here at 62. We're looking for 1-to-1 to the Aussie dollar over the long term. Japanese yen, of course, has been a disaster. It's at a 40-year low. Bank of Japan is tightening monetary conditions for the first time in 34 years. We're looking for a 20% gain somewhere. Euro also recovering here, looking for 20% there. And energy and commodities is the next important sector. It has been falling from 96 down to 78 as fears of a global economic slowdown continue. U.S. gasoline prices have hit a 3-month low on recession fears and replacement concerns by EVs, which are now 7% of the total new market. And by the way, they're offering 0% financing for EVs, something we haven't seen in that market for about 3 years or 4 years. Energy stocks are tracking the downside tick for tick, pulling down some other commodities. There is a buy setting up here somewhere, but probably not yet. And by the way, if you have any questions, just put them in the chat box on the right, and I'll address them at the end of the presentation. China's oil imports down 9 consecutive months, the world's largest importer. Natural gas is also bouncing back. Here is oil. See a little bit more downside, maybe down to 72. After that is 95 once interest rates kick in. And of course, we think oil is in a long-term, very long-term downtrend. Eventually could hit the $10 we saw at the pandemic low. It is in the going out of business sale, but it may take 20 or 30 years before we actually change over to a carbon-free economy. So don't play with matches. You could probably do okay just buying all the stocks I mentioned and forgetting about them. However, the reality is that conditions for these companies change every day. They're all viciously competing, trying to put each other out of business. One day they'll announce a partnership with each other. The next day they'll sue each other for copyright infringement or something like that. If you don't get daily updates on the fundamentals, you could easily get wiped out. Today's big winner could instantly become tomorrow's loser. That's why you need somebody like me to guide you through the thicket to avoid an out of the blue blow up. I gained financial independence for life, and so can you. All of this can be yours. Discover how to make thousands of dollars a year in extra income, go from complete beginner to seasoned pro in weeks, learn how to quit your day job and trade for a living full time. Trade from anywhere, anytime. Supplement your retirement income with the satisfaction of booking winning trades by the hundreds. And if you wonder why I'm smiling, trying as hard as I can to smile in this picture, it's because I'm sending you a trade alert from the coast of North Africa, where it's 120 degrees. The harsh truth is you really need my help. Majority of individual traders lose money. They lack the correct training and discipline to succeed. Most broker research suffers from grievous conflicts of interest. Wall Street is all about moving money from the uneducated to the educated. The easiest solution to that is to get educated. Fidelity did a 20-year study and learned that their top performing investors were dead people. Why did dead people do so well? They never sell. Not a bad thing when the Dow is in the process of going from 600 to 40,000, which it has done during my career. And this is the last broker I talked to. I met in Northern Italy. His name was Pinocchio. You need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. There are a few great sectors and a lot of awful ones. You can earn a 10x return on the great ones, but get wiped out by the losers. Let a 55-year veteran steer you to safe waters. Let me sit next to you and guide your hand on every winning trade. 51.57% average annualized return for 16 years versus 24.61% for the S&P 500. That's the orange chart down here. We're running at more than double the S&P 500 over a 16-year period. And when the market has giant sell-offs like it did here during the pandemic, we just stop out and go short and hold our positions, hold our performance level, then go right back up again. And this has been the pattern time after time, with the algo helping us at every stage. Richard made millions religiously following my trade alerts. He now spends his retirement restoring vintage aircraft and flying them from over the California coast. Sometimes he lets me fly them. Greg turned 100,000 into 3 million solely on my trade alerts. He bought a new home in Orange County, California, with Tesla solar panels, a Tesla Model 3, and still had enough money to send 3 kids to college. And here is another happy subscriber to Mad Hedge Fund Trader.
Hi, this is Bob. I live near Denver, Colorado, and I'm hiking on top of the Continental Divide. 9 months ago, I joined John's Global Dispatch Service and was so impressed with the profits I made that 2 weeks ago, while hiking in the Dolomites, I joined his concierge service. And in 2 weeks, it is 100% paid for it, and I couldn't be happier. Life is good. John really helps. The other day, I had a text message exchange with him regarding some concerns I had with TLT. Put spreads, he encouraged me to stay in. I did, and today they went out at 95% of maximum potential profits. And that's the way it works for me. I hope you all do well trading yourselves. Thank you.
So what do we do about all this? Well, stocks buy the next dip, bonds buy the next dip, commodities buy dips, energy buy dips, currencies buy foreign currency dips, precious metals especially, you want to buy dips. So if you're not up 51.77% in the past 12 months, as I was, you were reading the wrong newsletter or following the wrong trade mentoring service. And here's our service updated for the last year, 56.98%. And notice we never have any substantial downturns. We just keep trading and then stop out, go 100% cash, when the conditions are no good. You get performance like that, you get to do things that other people can't do, like ride the Queen Mary in the owner's suite from New York to England. Once you get to England, you can take the Orient Express to Venice, Italy. And in Venice, you can go island hopping on your own private helicopter. This is the very long view, and here's where the big money will be made. The 2000s and 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones, as the global demographic wave brings on a new golden age. 85 million millennials will become big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, fade from the scene. That will create an economic boom that will last another decade, and that started in October 2023. And that's me watching climbers on the Matterhorn from my home in Zermatt, Switzerland. From 1980 to 2000, the Dow average went up 20 times in 18 years. Are you ready for a replay? That's what happened the last time we had a demographic tailwind identical to the one we have now. Assuming the bottom is 2009, if we go up 20 times in 18 years, that takes us to 120,000 by 2030. Yeah, that sounds impossible, up, triple in 5 years, but we've already done 400% over the last 13 years. So if you think I'm crazy, look at where we are now. We've already done 2/3 of the work. We only have one more triple to go to get to 120,000. Except this time it's different. Now we have the AI technology turbocharger. Tech is hyper-accelerating on all fronts simultaneously, and the pandemic greatly sped up the rate of change. The development of functional quantum computers means that computational ability is about to increase 1 trillion-fold at no cost. The world's major computational challenges will certainly be solved, such as weather forecasting and cancer cures. All major human diseases will be cured within 10 years. Needless to say, barbell stocks dominate, and this scenario will account for the bulk of stock market gains in our lifetime. The 90s had cheaper computers, cheap operating software, and a new internet. The 2020s will have 10 times this number of new technology drivers. And this is a picture of a quantum computer, which is basically a giant freezer because it has to operate at minus 274 degrees zero. We'll show you how to play the next 90,000 Dow points. Sit with me, John Thomas, the Mad Hedge Fund Trader, in my Global Trading Dispatch. Discover how you can top into the top trade performing service in the industry, up 151.77% in a year. Follow my research and market beating trade alerts and you will rake the profits in. Let a Marine combat pilot steer you to big profits. We put out trade alerts on single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. And no, that is not the plane I flew in Desert Storm. That's a 1932 de Havilland Tiger Moth. Notice the design flaws. Gas tank directly over your head and no brakes. That's why we can only land on grass fields. This is a typical trading month for us. You can see we bought the S&P 500, made 16.3%, sold short US Treasuries, made 8%, bought the Russell 2000, bought Amazon, bought Apple. Oops, we bought Biogen, stopped out with a 21% loss. We stop out of losers quickly. It's easier to dig yourself out of a small hole than a big one. And then you can see the rest of the trades for the month made money. Just a matter of time before barbell stocks break out to new all-time highs. Watch this space melt up for the rest of 2024. Get ready to start reeling in those whoppers with Global Trading Dispatch. Here's how it works. Our algorithm predicted another upside breakout for NVIDIA back in January, so we sent out a buy signal back when it was at 473 a share. And this is what it looks like. Buy NVIDIA at 480 or best. It's an opening trade. You put 10% of your portfolio in there, that means buying 21 shares for a $10,000 exposure. What happened? Well, NVIDIA made it up to 693, literally in weeks, up 45% in 22 trading days. So what did we do? We sent out a sell alert. Most services don't bother to take profits. They tell you what to buy all the time. And this is what the sell alert looks like. Sell NVIDIA at $695 or best. And on this trade, on a $10,000 investment, we made $4,515 in 22 days. So here's our 10-bagger Hall of Fame recommendations that we made where the stocks went up 10 times or more. Zoom went up 10 times after we bought it. Lam Research, we got a 10.6 gain. NVIDIA, we got an 18 times gain from our initial purchase. Square, we got a 25-time gain. Moderna is up 40 times. And Tesla, the granddaddy of them all, up 175 times from our initial average cost of $2.35. That's split adjusted. Tesla has split 12 times since the beginning. So with my service, you get instant trade alerts set out at market sweet spots, about 200 a year or averaging about one a day, and all the reasons to execute them. Live bi-weekly strategy webinars and an interactive Q&A, special reports on urgent investment topics, invitations to strategy luncheons all around the world, more educational videos and webinars than you could consume in a lifetime, access to a 16-year database on investment ideas, searchable by names and ticker symbols. And I'll even give you the name of a surfing school in North Africa with a seniors division. Watch out, it's a lot harder than it looks. This is the one-stop shop. Learn all you need for every level. It's for individuals who want to understand what is happening in their retirement funds. It's for people who want to learn how to trade for a living, get the financial education of a lifetime. It's for smaller institutions and financial advisors who can't afford an in-house research department. Get in before the next melt-up begins. This is what you get, a newsletter in your inbox every morning before the market opens on every investment theme we're currently pursuing. We also give you Mad Hedge hot tips, the 5 most important things that happened today and what to do about them. This is what I'm not going to charge you for this service. I'm not going to charge you $100,000. That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. And I'm not going to charge you $12,000. That's what I charge my concierge clients who get my personal cell phone number so I can be their investment 911. And this is what I'm not going to charge you. This is what we charge on our website, $3,500. It's the full price of what I'm offering you on my website. This is the real deal. Creating this product cost me millions of dollars. With the best customer service in the industry, running it cost me millions more. 6 months for just $997. That is a 71.5% discount to the website price. It's a limited time offer. We only take 25 new subscribers at a time, so we don't overwhelm the market with everybody piling in on our trade alerts all at once. So it's first come, first serve. I can't wait to make you a top drawer trader. Just click on the chat box on the right, and let's see if Jeffrey has got it in there. Not yet. They'll be there shortly. Let me make the money for you to pay for.
It's in there.
That's it. Just sort of. Yeah, there it is. MadHedgeFundTrader.com. Blah blah blah. You make the trades. Discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. Just 6 months for $997. Okay, and buy now when you'll instantly receive a trade alert with an extremely high probability of success that you can execute immediately and make some of the most serious money in your life. Don't leave good money on the table. 90% of these trade alerts make money. And here's the chart for this secret trade alert. And it's so secret, I couldn't even put the chart up there. And what I'm not going to tell you is whether it's a buy or a sell. So while you're looking at the order page for my service, let me tell you who is John Thomas. If you're going to spend the next few minutes with me and the next 6 months working with me, it's best to find out who I am. My family origins are very humble, growing up as the oldest of 7 children on a remote farm in Southern California. I lived the all-American childhood, playing Little League baseball and becoming an Eagle Scout. There wasn't much to do in California in the old days but hunting, so I picked up a job as a paper boy for the Los Angeles Herald-Examiner. I found the stock pages, bought IBM at 20 and sold it at 30, suddenly found a far better way to make money than delivering newspapers on a bicycle. By the time I was 16, I earned enough money to fly to Europe. By the age of 17, I visited more than 50 countries and spoke 4 languages. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. Their yield didn't mean interest paid, but millions of Russians killed. I didn't see much of a future in that, so the government sent me to Southeast Asia for a few years of research where I learned to fly and jump out of perfectly good airplanes. There I advised the militaries of America's Asian allies. As the war wound down, I became a foreign correspondent for The Economist. When they learned I had a math degree, they switched me to covering the Asian economy and the stock market. And back in those days, doing research meant carrying a 45 caliber stun gun everywhere you went, which was left over from World War II and used to jam all the time. And after a decade of government service, all I ended up was with this box of medals, which I tried out once a year on Veterans Day. As a foreign correspondent, I covered China during the Cultural Revolution, was the first American reporter to visit North Korea since the Korean War, and covered the rest of the continent all the way to India. As I figured out very quickly, you didn't have to be that smart to make money in the stock market. So I got into the industry, joining Morgan Stanley. After 10 years there, I started my own hedge fund. You can see there's the original ID card for me in 1983. Yes, the years have been cruel. And that's me losing the All Japan Karate Championships, never enter a karate final with a broken wrist. I rapidly became the top performing hedge fund in the 1990s, eventually bringing in 1,000% return in a decade. As the money really started to pour in, it's an understatement to say when your income goes from the thousands to the tens of millions, it really has a big impact on your lifestyle. You get to buy the latest hot car, fly your own private plane anywhere you want, go marlin fishing in Mexico, and collect vintage Rolls Royces, which, by the way, almost don't go up in price. They're not like vintage Ferraris. I now spend my first love pursuing my first love, finding winning trade alerts. But now I do it for my 3 mansions in San Francisco, Lake Tahoe, and Zermatt, Switzerland. And I've quit turning millionaires into billionaires. There's far more satisfaction leveling the playing field for the average guy and teaching him how to trade, and that includes you. If I can take a $50,000 account, turn it into $500,000, there's more job satisfaction than I could get anywhere. In the little free time I have left, I love flying vintage aircraft. You see an old plane flying loops over San Francisco these days, it's probably me. The ultimate luxury course is to give to those who need it. I'm a major donor to Wounded Warriors, and when fires hit California, I visited the main evacuation centers and handed out $10,000 worth of Target gift cards. So this is my concierge member who collects Spitfires. And let's talk about him for a minute. When you make millions of dollars for your clients, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, free tickets to the Olympics, and dates with movie stars. So it's in that spirit that I traveled to the famed World War II fighter station at Biggin Hill in England to meet Mad Hedge concierge member Peter Monk. Peter was a poorly paid pilot for Ryanair when he first signed up for my global trading dispatch. After doubling his money in the first year, Peter upgraded to my concierge service. Then the money really started to pour in. Peter plowed his Mad Hedge trading profits into restoring a 1940 Battle of Britain veteran, a Supermarine Spitfire Mark IX, in his backyard begging, borrowing, and trading for parts all over the world. He eventually built his fleet up to 16 flying aircraft, which are today worth over $65 million. When Peter invited me to fly one, I jumped at the chance. It was a mild, blustery day when we took off and headed for the English Channel. Even with the plane, it was 82 years old, we managed a brisk 250 miles an hour over the countryside. The Spitfire could outmaneuver any plane the German Air Force threw up against it. This particular plane is credited with shooting down 2 Messerschmitt Bf-109s during the Battle of Britain. We found a clear piece of sky over the White Cliffs of Dover between 2 big, fluffy cumulus clouds and commenced a full-on aerobatic flight test. Pilots always want to see what I can do in these old planes, and this time was no different. I executed multiple loops, barrel rolls, chandelles, lazy eights, Immelman turns, and wingovers, careful never to exceed 1G limitations, or the wings might fall off. Spitfires can dive like crazy. We dropped from 8,000 feet to 2,000 feet in seconds. Then it was back to Biggin Hill for a perfect 3-point landing and a pint of beer. Let me make millions of dollars for you as well, as I have done for thousands of followers over the last 16 years. I look forward to working with all of you. Okay, so here's the offer you can't refuse. 6 months for just $997. Let me show you, pages keep jumping. There it goes again. Let me show you how to make the money to pay for your own subscription. Just click on the chat box on the right. And if you have any more questions at all, just go ahead and shoot. The link is in the chat box on the right. And Jeffrey, that just about does it.
Do you have time to answer just a couple questions?
Absolutely.
Steve says, how long is your average holding period?
Well, if we do everything perfectly, it's a month. We put on a trade, we run it into expiration in the options market, and the trades expire at max profit. And that is what happens 90% of the time. 10% of the time, we stop out with small losses. So that could be anywhere from days to weeks. Remember, over trading makes your broker rich. It doesn't make you rich. So we try to keep our trading to a minimum, just get people a few high quality positions where they can then run for the month.
All right, cool. Barry wants to know, I don't use options here in England. I'm just buying and selling shares. Will this be helpful for me? Thanks for the question, Barry.
Yes, actually, only about a quarter of our subscribers do options. The rest don't have the time or the background to do it. And over time, every trade alert we send out has a stock, an option, or an ETF choice you can take. And over time, the people who buy the stocks make the most money. And I'll give the example of NVIDIA. Last October, we put out call spreads on NVIDIA, which made a nice 20% in a month. People who bought the stock made more than 100% in 4 months. And you often see that repeating itself over and over again, and which is why we have so many 10 baggers, the people who bought the stocks and got in early.
Cool. And then this one's more of a comment. Robert says, I'm ready for a replay. AI and quantum computing will be big players. Awesome and useful information. Thank you, John.
Well, he's been doing his research, and he will be rewarded. And who will be doing the rewarding? And that's Mr. Market. You do your research, make your bets in the right places, you will be richly rewarded. That's all I can say.
Very good. Thank you, John. I appreciate that. And Barry says, thank you from England.
Okay. Pleasure.
Very cool. All right. Really appreciate you coming in. Always enjoy having you. Thank you very much.
Catch you on the next one.